Hey, good morning, everyone. Good morning. How many? Okay, anybody? I think.
Good morning, Professor.
Hey, good morning. Is it Anna?
Yeah, it's Anna.
Oh, hi, Anna.
Hey, how you doing?
Good, how are you? Nice to hear your voice.
Thanks.
Hey, the students aren't responding at all, as if they are completely deaf. I see only two people. Zechariah is
Good
just
morning,
joining.
Professor.
Hey,
How
good
are you?
morning. Good morning, Zachariah. Good morning. It's almost like if one person is losing connection or dropping out of connection, another person is joining, and that person is losing connection, then the other person is joining again. Ah, okay. So it looks like a very unstable morning as far as the connection is concerned. Well, so. Uh, Everyone understands the quiz 2 is starting this Friday, which is tomorrow. And so we are moving on to the new topic today. Oh, what am I doing? Why am I? Um, so let's see. I I have only four people. This is a disaster. Okay. And then let's see. No, no, this is not this class. So all right. So we have we have just Justin Fortes that just joined now. We have a couple of things left in the bond valuation, but again, what's left is basically there are um, two things left. Okay, just if I open this, okay, let me open it like this. Uh, Basically, what was left is the callable bonds, right? Call provision, right? Call. Uh, the bonds can be either callable or puttable, but this is something you can just read up. We don't have time. I mean, I wish we had time for this, but we don't, and it's something you can basically study, right? Something you can read up. And then one thing I really wanted to focus on was the interest rate risk. Now, please read that carefully. Um, Interest rate, maturity, maturity risk, interest rate risk, price risk, they all mean the same thing. Okay, and that's it. Um, Bond rating, that's something we already know. Rating system, right? Triple A, single A, triple B, right? So we're not going to talk about the bond anymore. That bond was already wrapped up, and by the main lecture, it was already covered. Everything was covered. You should go by the main lecture, not by the collaborate session, right? As I've been telling you all the time, collaborate session is only a reflection, okay? Review and reflection. So we are now moving on to the risk and return. Okay. So I'm going to close this. Okay. So I have 7 people currently. So now let's think about, we already know what return is, right? We know how to calculate return. Basically, first of all, we know how to calculate holding period return. Holding period can be um, any number of years or even, any number of days, weeks, but we all understand it's PT plus N minus PT, right? And price at time T, we are price at time T is basically, the beginning of the holding period. Price at time T plus N is the price at the N periods since the beginning of the holding period. So obviously, we know what this is called. This is called capital gains, and there could have been cash flow, right? There has been, if there has been additional cash flow, right, such as uh, interest payment or coupon payment, or in case of stock, dividends, right? We have to add that in. And if you remember, and then you have to divide it by your initial investment of PT, right? Now, if you remember from our topic 1, house value, right? In the house value example, we had 2 scenarios, right? Scenario 1, scenario 2, right? If you remember that, in scenario 2, we really have capital gains and cash flow, right? Do you remember that? Because, scenario 2 is like, subletting your place, renting it out. So there will be, over time, there will be capital gains or capital loss. But, also during that holding period, you have, rental income. And I've been telling you, the bond is just like this. Coupon bond is just like this because coupon bond, there will be capital gains or capital loss, and there will be, like every 6 months you have coupon payments, right? Uh, in scenario 1, you don't rent out the house, so there will be only capital gains or capital loss. There's no, right, additional cash flow. And I told you, so this is just like the uh, uh, zero coupon bond, right? Just like zero coupon. And this is just like coupon bond, right? So this also applies also to stock. I mean, if you bought stock at, think about it, at time 0 or time t, you bought it for, whatever price. And later, n years later, or n months later, the price may have increased or decreased. So there will be capital gains or capital loss, right? And in the meantime, there could have been uh, dividends, in case of stock, uh, dividends, right? Now, this is basically, so the holding period is, in this example, holding period is n, n periods or n years, whatever the time unit may be, right? Whatever the unit may be. Um, but if n is 1, suppose n is 1, just one period, and what does one period mean? It can mean 1 year, or it can mean, 1 year, 1 quarter, 1 month, right? 1 week, even 1 day. So in case uh, so if n is 1, it's just a single period return, and the single period return is, it's easy. It's just, pt plus 1 minus pt. And if there has been any cash flow, such as, a dividend during that period, dividend at time t, or cash flow at time t, right? Divided by pt. Okay, so this is, once again, single period. Think about it. It can be 1 year, 1 month, 1 quarter, right? And here's something we need to remember, something we need to remind ourselves of, something we need to be reminded of, which is we don't know. I mean, this is only theoretically pt plus 1, but do we know what pt plus 1 is? Do we know that? Huh? We don't know, because t is now, right? T is now present. Then think about it. So if t is this year, t plus 1, that means t plus 1 is next year, right? So how do we know what the stock price will be next year? Of course, we can use a forecast. We can make a forecast, but forecast is not the reality. Forecast is only a forecast. Forecast is not the reality. So basically, we can have expected pt plus 1, okay? And then expected pt plus 1 will give you only, it doesn't give you any actual return. It will give you only anticipated return, right? So let me open, oops, what happened to my mouse? Whiteboard. So this is going to take some time. So because we cannot tell what pt plus 1 is, actually, this if we have pt plus 1 there, this should be also rt plus 1. So this is only theoretically so. For in reality, what we can do with the existing data, actual data, because we don't have the data for pt plus 1, right? If that is next year, we don't have actual data, next year data. It hasn't happened yet. So the best we can have is pt minus 1 over pt minus 1. So this is what? The return between last year and this year. Okay? and then if there has been dividend, right? Dividend at well, that was t plus 1 here, dividend at t. Okay, so this is the practical this is actually the practical form this is the practical form, right? So let's see if I so when did I talk about this? So now let's think about it. Again, so we can calculate one period return at time t, which is, basically pt minus pt minus 1 plus all the cash flow during the, during the one period, right? Divided by pt minus 1. Now, here's the thing. If this is a stock, if this is a bond, this means 2 coupon payments, right? If this is a bond. However, if this is a stock, this would mean 4 dividends. If t is a year, right? But even if it is 1 year, some stocks, not all the stocks pay dividends. Some stocks may pay dividends. Some stocks may not pay dividends at all, right? So dividends are optional. It's not like interest, right? If you buy bond, you have, fixed interest, as long as it's a coupon bond. As long as it's a coupon bond, you have fixed interest payment, in other words, coupon payment. But if it is stock, dividend is not guaranteed, right? It's not guaranteed. So, and besides, what if t is not 1 year? What if, what if t is just 1 month? If t is 1 month, then there is no coupon, there is no dividend, right? There is no coupon, no dividend, because it's quite obvious. If it is bond, right, you have to wait at least 6 months to collect coupon. Of course, if you bought at the beginning of the time, if you bought it at time 0, but if you bought it in the middle of, let's say, in the 5th month, and in the 6th month, it's just 1 month later. 1 month later, you'll because you bought it, you must have bought it from someone else who was holding it before, and then if that's the case, the price you pay is already including the coupon partially. Five sixths of that coupon belongs to the guy who was holding it for 5 months, right? And you would be entitled to only 1/6 of that. So the price you pay will already include that, right? But anyway, if you haven't hold it, if you've in case of stock, if you haven't held it for more than a quarter, the dividend, you don't receive dividend. I mean, let's say you bought the bond, you bought the stock after it has gone X dividend, which means they have just paid dividend. And after dividend, right, X dividend, you bought the bond stock X dividend, and then you will have to wait 3 months, one quarter, one full quarter, uh, to get a dividend. So in other words, monthly. But if you are holding it just for 1 month, if you are holding it for just 1 month, uh, no dividend, right? So in that case, this term drops out, right? This term drops out. Okay. But having that in mind, let's think about, let's get the real data. Okay. So I want you to all go to Yahoo Finance. Okay. Go to Yahoo Finance. I have only 4 people here. What's going on? I already explained, I believe I explained last time how I can check if people are logged in. I mean, I have how many people here? I have 7 people here, and then only 4 here. And I can check who was logged in, and uh, on Collaborate, right? In Collaborate, I can check who was logged in and who was not, and for how many minutes they were logged in. I can check that all. So if you just sign in here, but not here, then I will check if they have really logged in. And if they are not logged in for 50 minutes, I mean, today we have 50 minutes, right? Tuesday we have 1 hour, 40 minutes. So if I don't see the login duration such as 50 minutes or 1 hour, 40 minutes, then those people will be marked absent, right? That's the only way. But are you guys on Yahoo Finance? Brianna, are you on Yahoo Finance? Brianna? Reynold? Are you on Yahoo Finance? Sorav? Zechariah? So nobody's here. Nobody's here. Reynolds, you didn't hear me? Go to Yahoo Finance. Are you on Yahoo Finance? What about the other people? You're on Yahoo Finance? So if you are on Yahoo Finance, let's look up Apple, okay? Apple's ticker symbol is AAPL. In the old days, even in 1990s, you had to exactly enter the ticker symbol. Now you can type in literally APPLE, right, for Apple, or just A, it comes up. So, okay, we got Apple, and we can go to chart, and then 5 years, let's say, want to look into last, how it did last 5 years, and this isn't percentage, so you want to put it into a month, right? Monthly data, and everything is it's in percentage because I'm making a comparison with the Nasdaq and S&P 500 and so on. So let me get rid of these, and then it's in price. Okay, monthly data for the last 5 months, for the last 5 years. Okay, currently 161.79. So this is as of uh, yesterday, right? As of yesterday, close price yesterday or last month, because we are using monthly data. Yeah, that must be last month, as of the end of last month. Now, or as of today, because April hasn't ended. So today's date is the latest monthly data we have. Now, and if you want to extend it to maximum, because think about it, Apple has been around for 40 years. Apple has been around for 40 years. Not weekly, let me get monthly. Okay. The beginning of Apple was like 1981. 1981. Okay. So in 1981, the IPO price was about $10, and since then, it looks like it is, like 10. Looks like it is almost like 12 cents here, but that's not. Uh, that's called a proration. Okay, it's almost like Apple was like 12 cents. No, it's because Apple has gone through many splits, multiple splits over the years. So it is reflecting, after adjusting for uh, split, right? The post-split price would have to be smaller than pre-split price. So, in other words, think about it. If Apple was $100 and let's say they had, 1 to 10 split, 1 to 10, one stock splits into 10 shares, then the price will be $10. So you might think, then I will be suffering, I will be suffering from the capital loss. No, there's no capital loss, because if you had one share that was $100, now you have 10 shares at $10, so you still have $100 in Apple, right? That's the split. And look at this, split here, split here. I mean, there were many splits somewhere here, many splits here. It's all dividends. They pay dividends, and these are dividends and splits. See, there were dividends, and if there were splits, and 2020 August they had split. So after split, the price is adjusted or prorated so that the all the pre-split prices are prorated to be in line with the post-split price. So because of that, it looks like it was as if it was 12 cents, but it was actually, when it was first sold, it was like $10. And then over the years, Apple actually grew. I mean, if you do the calculation, it's almost like 129,000%, almost 129, 129,000%, 130%, 130,000% growth, 1,000, 300-fold growth. So uh, if you had put 1,000 into Apple in 1981 at IPO, it would have grown to 1.3 million, 1.3 million by now. Okay. But that's not what we are interested in. Let me reduce it to 5 years. Okay. Even during the most recent 5 years, there was a split here, and all the, and you can see that there was a long period during which Apple didn't pay any dividends, right? Now we want to get the data, so we go to historical data, okay, and then we want the last 5 years, okay. So you can click 5 years. Then it's going to be 2017, April 2017 through April 2022, and then frequency should be monthly. I want monthly data. So then apply. Okay. Are you guys all here? Are you guys all there? Okay, Reynolds. What about you? What about other people? Zachariah, Sorev, Zachariah. Brianna. Jesus, nobody's, just one person. Okay, if you're not responding, I will have to assume that you guys are away, and I'll have to give you, I'll have to take, points. I'll have to give you -5 points for not participating in the class, and everyone that's not even here will be given -5 points for not participating. You will be given, minus 0.5. So, so you see, once you hit apply, then all the data, it will show when they paid dividend, right? And how much dividend they paid. Now, of course, they paid dividend in February, and then that cannot be the dividend. I told you dividend is paid quarterly. So this cannot be the dividend from the first quarter, because first quarter ended on March 31st, right? They cannot pay dividend before the quarter ends. So this dividend is obviously not the first quarter dividend, but the fourth quarter dividend, right? Fourth quarter, 2021 fourth quarter. So 2021 fourth quarter 2021 must close, and December 31st it closed, right? And then after closing, then they compiled the data. And I told you, I've been telling you, the first month of every quarter is called earnings season, because earnings report comes out in the first quarter. I mean, first month of the following quarter, right? That's the only way it can be. So when and then once so it's called earnings season because the earnings report comes out. And once the earnings report has come out, then they can calculate the dividend. So they will pay dividend is some percentage of the EAT, quarterly EAT, right? So then, they pay the dividend in the second month of the quarter. So this dividend is fourth quarter dividend, right? 2021, fourth quarter 2021. And this is third quarter 2021, third quarter dividend. Okay. Now, what do? We have to download this data. Okay. So you hit download, and it is downloaded as a CSV file. And CSV file is not Excel file. I mean, it's data file, just data file. It's not Excel file. So we need to save this as Excel file first. So here we have first, once you open that file, select the entire worksheet by clicking on this corner. And I will first increase the font. I'll first increase the font and then change the font. So the font size 14, I prefer 14. And as for the font face, I prefer Georgia or Times New Roman. Okay, because it's less. These fonts are the best for the human eyes. It doesn't make your eyes. It doesn't tire your eyes. Okay, other fonts really make your eyes tired. And when you are dealing with numerical data, if it was in the original font, you get easily um, uh, you get easily tired of it. So it's first thing is to change the font. And you would hate to see the numerical data if the font is unappealing like that. So first, I will. This is the original data set, so I'm going to leave it just as it is, and I'm going to leave it just like that, and just copy the whole thing. Copy and open another worksheet and paste. Okay. All right, I'm warning you. I already said, at least Reynold is here. Reynold has been responding. About other people, you can respond within the next 10 seconds. I will have to assume that you are not here, so you will be marked absent. Okay? Just logging in and staying away doesn't mean you're present. Okay? And just like other people, I mean, there are people that logged in here but are not here, right? Not participating in class. You can't get credit for attendance. Okay? Brianna, are you there? Sorav, are you there? Zechariah is reconnecting. Reynold, are you there? Okay, Reynold is here. Okay, I can. Zechariah, are you there? Zechariah?
Yes, Professor.
Okay, so only 2 people will be recognized as present, and the rest of the class will be all marked as absent today. Okay, so this is at some point, I have to draw the line. Okay, I cannot let this go on. It's basically irresponsible, right? It's irresponsible of you to be, behaving this way. So, okay. So back to this. So here I'm going to only use the data that I'm going to wean out the data, or what should I say, sort out the data that I don't need. First of all, you can see that there are 4 price points, right? Which is, open, high, low, and close. Now think about it. Whenever the market opens at 9:30 a.m., closes at 4 p.m., right? So during the day, the trading hour, that's the trading hour. During the trading of the day, there can be 4 price points, obviously, right? Opening price at the open, right? And then price at the closing of the market, and then high during the day, during the day's trading, the highest price, and during the trading of the day, the lowest of the price. Okay. Now this is not daily. This is not daily uh, price. This is monthly. Monthly, right? But it's the same thing in the month. I mean, during the trading of the month, uh, the price when it opened, and the highest of the month, lowest of the month, and closing of the month, closing price of the month. Okay, so first of all, this data is in ascending order, which means from the earliest date to the latest date, from the oldest to the newest. I want to put it in the opposite order, okay, in descending order, because that's more, that's more convenient to do it that way. So how do I do that? You must do this with me. I told, I, I've been telling you to download this file, and I've been showing you all this. And if you haven't downloaded, and I don't know what to do, you should have downloaded it first. I've been how to select, date, the time range, how to select the data frequency to be monthly, and how to download. I've all demonstrated to you. And if you haven't done it, then too bad. Your fault, your responsibility. Um, so if you have the data like this, then select one of the one of the dates, and go to home, and here you can sort newest Z to A, that's descending order, or highest to the lowest, or newest to the oldest. And then we have it like this. Okay. And then actually I should have started from April of 2017. That way I will have uh, 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 enough data, more than enough data. Just, but anyway, right now volume is not needed. Volume is not needed, so I'll select that column and delete it. Open, high, low, I don't need that. Why? Because no matter what, no matter, think about it, during the trading of the day, it doesn't matter how high the price went up, or how low the price fell, or where at what price it opened. It doesn't really matter, because the conclusion of the day's trading is the closing price, right? Closing price is the conclusion of the day's trading. So I will use only closing price. So open, high, low, I don't need that. I will delete it. Then I have close price and adjusted close price. Now, what's the difference? Now think about it. Um, uh, the day close. You remember that they pay dividend, right? Apple has been paying dividend, but the dividend is paid quarterly, every 3 months, right? So uh, in February they paid dividend, which is the actually dividend for the uh, last quarter, fourth quarter of 2021. But think about it. Monthly data cannot monthly data, except for 1 month, one particular month, monthly data are not reflecting the dividend. I mean, in a particular month, there is dividend, but other months, so every 1 month out of a quarter, there is dividend, but um, other months, 2 months, two other months don't have any dividend. So we have to make adjustment for this. If you have to make adjustment, manually, month by month, it's gonna be, it's gonna be a hell. Um, and besides, you might think, oh, so can we not spread, can we not spread that, quarterly dividend over 3 months? No, that's dividend is paid in a particular month, so you cannot do that. Um, if you cannot artificially spread the dividend across 3 months. That's, because that's not the reality. So you cannot do that. Um, so what we the reason we use adjusted close, the adjusted close is, uh, adjusted. That means it's adjusted for dividends and splits. Okay, dividend and splits, right? It's adjusted for dividends and splits. Okay, so what we need is so if we use adjusted close price, then this formula will be quite simpler. It will be simply, we don't need to worry about the dividend. We'll just use this for the monthly return. We can do this just for, for monthly return. So that way, okay, that's why, I'm gonna use adjusted close price, not the close price. Okay, so I'm gonna delete the close, and so this is basically PT, right? Price at time t. So that means we can do based on that PT, we can find return at time t, right? So this one, we're out of time, so we cannot even we cannot even find, we cannot even do that today, but we'll do this next time. So please save this file. Please save this file. Of course, in the main lecture, I have already explained everything and demonstrated everything. So study the main lecture. Okay, you save this file because as you can see, it is CSV file, CSV, which is not Excel file. So you'll have to save it as Excel file and name it, whatever. But I will name it S22. This is section 1100, right? 1101. Okay. A 22S. I'll name it 22S 1101. Okay. So save it, and we'll continue with this next time. So I will see you next Tuesday. Um, so stop recording and sign out. You have a question, Reynold? I always give you a 3-day window If so, if it starts on at 12 midnight, if it starts at 12 midnight Friday,